Hello, everyone. This week we will begin Chapter 4, Why Do Interest Rates Change? We'll do a couple practice problems that are in the book, and then we'll talk a little bit about supply and demand. So first is a simple example about expected return. What is the expected return on ExxonMobil bond if the return is 12% 3/4 of the time and 8% the other quarter? This is just a simple weighted average. So the P is probability, R is return. So 3/4 of the time would be 75% at a 12% return, plus the other 25%, the probabilities have to add to 1 of an 8% return. This works out to 3/4 of 12 is 9, 1/4 of 8 is 2, so the expected return is 11%. Simple example, I'm sure you've all seen something like that. Now moving on to risk. Sometimes this is called volatility, and this is measured in standard deviation. And also, this is not in the book, but I wanted to mention there's something known as a Sharpe ratio, which is just the expected return scaled by the standard deviation. So it's a measure of return per unit of risk. Of course, one of the fundamental principles of finance is the relationship between risk and return. So an example here, firm A has expected stock return of 15% half the time and 5% the other half. Firm B has an expected return of 10% that does not vary. Calculate standard deviations for both, which is riskier. So first, this is the example in the book. Obviously, that the firm B, it says it does not vary, so intuitively we know the standard deviation is 0. So I'll move on to a little bit more exciting example. And I also wanted to provide this little graph here just so everybody can see what's going on, where this does not pertain to the example above, but imagine firm A, the returns look like this over time, and firm B is in the red, where they're both the expected return is 10%, but clearly firm A is more volatile. Hence, it's riskier. Okay, so for firm A, and this is similar logic to the expected return, which is a weighted average. This is sort of a weighted average of volatility. And again, well, I guess first we have to calculate the expected return. As you can see, it's here in the formula. So the expected return for A equals 50% of the time, says half the time at 15%, and the other half at 5%. Half of this is 0.075, and half of that is 2.5%. And this adds up to 10%. Now for the standard deviation, so this here gets filled in here and here and here. Okay, so again, I'm just following the formula above here. 50% of 15 minus 10 squared plus the other 50% of the time at 5% squared. And then this whole thing, you have to take the square root. This works out to be, apologies for the messy handwriting. And if you notice, the 15 and 5 is the same distance from the expected return or the weighted average return of 10. So you notice that it contributes the same amount, 0.0025, to the volatility or the risk. So all of this works out to 5%. And it's trivial to show that the other one is from just this little portion here. It's the expected return is 10, and it's 10 the whole time, so 10 minus 10 is 0, and then the whole thing works out to be 0. So this is firm A, firm B is 0. So of course it asks which one is riskier. Of course firm A is riskier. And again, it's trivial because the one is 0, so we can refer back to this example here. So we know, again, here the 11% is the expected. And this works out to be 0.3%. You all can check my math on that. And of course, here, still, firm A is riskier because 5% is higher than 0.3%. Okay, moving on to supply and demand. First, I'm sure everybody has heard of liquidity, because we're going to go on to see what things affect the movement of supply and demand of bonds. And liquidity is just something that it's more liquid means that it's more easily bought and sold. So, for example, cash is the most liquid asset because you can use it instantly. Whereas if you had a classic car or something like that, it may be worth a lot of money, but you can't sell it at the drop of the hat. And another note on discount and premium bonds. I don't think they say this in the book that clearly, but the reason that bonds can be sold at a discount or premium is because movements in the coupon rate. So today, if I buy a bond that pays a 5% coupon, and then next year bonds provide 7% coupon, those are going to look more attractive. So my bond will now be at a discount. And on the flip side of that, if rates go down and I still have a 5% coupon, and in the market you can only get a 2%, then obviously my 5% bond is worth more. Okay, so I'm not sure if everyone is required to take basic economics, so I don't know if you all have seen this before, but this is just a basic graph of supply and demand where the blue line is demand and the orange line is supply. And of course, where they intersect is the equilibrium quantity and price, denoted here with Q and P. So for demand, and recall from this formula here, this is just simple zero coupon bonds, that if present value goes down, the expected return goes up. So this is good for the lenders or those who are buying the bonds or demand. So as the present value goes down, the demand goes up. And on the flip side of that, for suppliers, or for borrowers or supply, as price goes up, firms obviously can get more money, and so they want to issue more bonds, all things else being equal. So this is what I was here. This is all movements along the line. And now we move to shifts. So this is different. So a movement would just be from here to here to here, or here to here to here. And now for shifts in demand and supply, starting with demand, there are a few things that have a positive relationship and a few things that have a negative relationship with demand. So as wealth and liquidity increase, the liquidity of bonds, that is. So if more investors are entering the market and they're trading, that means that there's more people to trade them, liquidity goes up. And as those wealth and liquidity go up, so does demand. And here you can see with the green line that the demand curve shifts to the right. And again, all things else being equal, this results in a higher, this should be Q here. This results in a higher equilibrium quantity and a higher equilibrium price. And the opposite of that, expected interest rate, expected inflation, and risk, if those go up, then demand goes down. And it's a negative relationship. So obviously the opposite of all of these things is true. So if all those things go up, then demand goes down, then demand goes up. And like I said, the logic behind the expected interest rate is what I just went over with the premium and discount bonds. And it's similar logic for inflation. And for risk, it's generally assumed in the literature that investors are risk averse in financial decisions, so that's why that's true. And that kind of goes back to this picture. People tend, again, for a given rate of expected return, people tend to prefer firm B here. That does not vary as much compared to firm A. And again, that's reflected for the Sharpe ratio. So here, firm B has a lower standard deviation, which means the Sharpe ratio is higher. Now for shifts in supply, there are less things that affect supply according to the book, and they're all positive relationships. And the result of these is different from the shifts in demand in that an increase in supply does increase quantity, but decreases the equilibrium price. And of course, again, these are all things, everything else being held equal, things can move all at once. Okay, so first for expected profitability of investments, this is from a firm perspective that if they have more, if we do think of Apple or Amazon or a firm or Tesla, they have more profitable net present value projects, and therefore they have a greater borrowing need. so they want to issue more bonds. And the second one is expected inflation. That is because the firm wants money today. It's worth more today if inflation is lower relative to the future. And also recall from Chapter 3 that the real interest rate equals the nominal minus inflation. So, of course, as inflation goes up, the real interest rate goes down, so the real cost of borrowing falls. So, again, in that case, firms want to issue more bonds. And lastly, government deficit. This one's pretty straightforward. If the government has a deficit, they need to make up between what they spend and what they're taking in. Of course, if they're at a deficit, they need more funding, so they issue bonds, and in the aggregate, that means that the supply of bonds increases. That's all I had for today. Again, if anybody has questions or wants to see other problems worked out, shoot me an email.